Hi, in this video, we'll introduce some alternatives to the CAPM or the capital asset pricing model. As we have seen that CAPM is not perfect by itself, it's not 100% accurate, and we shouldn't expect it to be as we have heavy assumptions on that. So remember those 6 assumptions on CAPM. And of course, it's just a very simple linear regression. Okay, it only includes one factor, which is the market risk premium. So for any statistical model or econometric model, including just one single factor is more than likely to be not enough. Okay, so the intuitive idea would be, let's just include more of it, right? So this is what arbitrage pricing theory, or the APT here, argues as well. So we can include even more factors or other macroeconomic factors here, right? So it's up to each factor or each firm, and you can construct different pricing models here. Okay, so you don't necessarily have to include the market risk premium itself, although it's most likely to be commonly used, but you can include others, and as long as you see fit and they're significant in a way. Okay, so let's just write it as this. Okay, so the return, return for the risky asset here minus RF. Let's use the risk premium as the basis here, so we can sort of unify the format here, right? Is dependent on the first beta and the first risky factor plus the second beta multiplied by second risky factor, and then all the way to beta n and factor n, and some noises here. Okay, so as long as you can identify those factors and you think they're meaningful and significant, then you can put them into this model here, and respectively, and then you can calculate the return or the expected return for any given risky assets here. Okay, so now the task here is to identify the factors. So based on this, or another model here is called the Farmer-French 3-factor model. As its name suggests, there are 3 factors they have identified. Okay, so Farmer and French being 2 different people here. So the 3 different factors include, first, the market premium itself. So it's the same as the CAPM. Okay, so the first will be the market premium, and the second is called the size factor. So it recognizes the difference of the size of the businesses in the market. So empirically, or as a intuition here, smaller firms tend to have higher return than big firms. So we put this into our consideration, and we put this into one of our factors as well. Okay? And the third factor is called the book-to-market factor, or think of it as a growth factor here. So we have high book-to-market value firms and low book-to-market value firms. So recall our previous example from the stock part. So when we're putting a price on a stock, so we need its book value, its growth, and we have the golden growth model. So we can see there's a difference between a market value and the book value here, right? So if you have very high market value but relatively low book value, then it's possibly there's a great deal of growth opportunities within this firm. Okay, so we have 3 different factors here. So one being the market premium itself, which is the same as CAPM, and then we have the size, and then we have the book to market factor here. Right, so let's write the model using our usual way here. So that's RK minus RF, which is the risk premium you're getting from this risky asset. It's going to be determined by 3 different factors. So first, beta 1 or beta market itself, which is the same as the CAPM itself, right? And the second one being the beta, we call it small minus big. Okay, the small firms minus the big firms return. Okay, so that's going to be R, S, and B as well. So how do we construct this? So the R, S, and B, or the risk premium for being a small firm over a big firm. So we can pull the data from the from the market itself. So if we have the top 10% biggest firms and the bottom 10% as the size in this market, we can pull out their return data, right? So we can use it to construct the risk premium. So how much on average is the smaller firms gaining over the bigger firms, right? So the same with the high minus low, or this book to market factor. Here we call it the beta, high minus low, and the risk premium for being a high book to market value firm minus the low book to market value firm. Okay, so now I have 3 different factors. So I would need 3 different betas here to determine the risk premium for our risky assets under consideration. So in the exams, you might be asked to provide some alternatives to CAPM. So you can come up with the APT or the Farmer-French 3-factor model and do a bit of explanation, and you should be fine. So if they give you a bit of numbers on the betas here and the risk, the RM or the small minus big and high minus low, then you might be asked to do a bit of calculations to determine the expected return for that particular risky asset. But then, as you can see, the calculations should be fairly simple just by plugging in the numbers, right? So as long as you can remember what the Farmer-French 3-factor model is about, then you should be able to do the calculations without too many problems. Okay, but for the arbitrage pricing theory, as an introductory stage, we're not going to dive too deep into that. Okay, so you could be asked different questions if you study a bit more finance, and especially on this part of arbitrage pricing theory. There will be a lot more calculations, and could use a bit of linear algebra. But for now, our introduction phase, as long as you know what arbitrage pricing theory is, then it's fine. Okay, so this is our introduction on CAPM and some of these alternative models to CAPM, and by remembering them and memorizing them and by understanding them, should provide you with a very holistic view on the pricing of the risky assets. I'll see you in the next video.